For 18 months, I saw the perfect setups, but I could never pull the trigger effectively. I'd either enter too early and get stopped out, or way too late and miss the move entirely. Now, I know this sounds familiar to you, but then I discovered something about entry models that completely transformed my trading. Now, it wasn't about finding better setups, it was about understanding the psychology of how price actually enters key levels. Now, today I'm going to be breaking down exactly the entry model that took me from a 40% win rate to over an 87% win rate. Now, this is not entry level stuff. We're going to be diving deep into the mechanics of professional entries, and by the end of this video you're never going to have to enter a trade the same way again. Now let me ask you something that reveals everything. When you see a setup, how long do you wait before entering? Now if you said immediately, or I don't know how long I wait, you're already losing. Now these are the factors that determine optimal entry timing. First of all, we want to be looking for three things to be present before we get into a trade. The first one starts with a D, and I like to call that direction. The second one is an L, and I like to call it liquidity. And then the final one is a V. So remember DLV. Direction, liquidity, and the final one is volume. Now, if all three of these things are present, you are essentially good to go in your setup. Obviously, understanding that we have all of the rest of the criteria present from your strategy. So let's say, for example, that we get in a position right now and we're looking to take a breakout model on buys. Well, do we have direction? Well, I would say actually, yes, we probably do. We're in a strong upwards trend right now, and you have a breakout above the level. Do you have liquidity being grabbed? Well, if we zoom in, you actually do have some liquidity below the bottom of this level right here, which is great. However, what time is it right now? It is currently 10 p.m. at night. The market is about to close and there is absolutely no volume. So would I be entering a setup? Absolutely not. So if you don't have all of these things present, make sure you have a checklist written down to remember DLV before you get into a trade. But here's what blew my mind when I studied institutional traders. They all enter at the exact same spots, but not for the reasons you think. Now, institutional traders target liquidity. They are looking for specific price areas to be tapped. But the most important thing about that is not where they're entering or the liquidity they're entering on. They are looking for specific areas to be tapped. And why is that? Is because they have specific criteria before they get into a trade. So for example here, with every single model that I take, I'm going to show you exactly how I find the liquidity in order to be able to take the position. Now before I get into a trade, I need to have a specific amount of liquidity present. And how do I identify that? Well, the first thing I do is look at previous price action data. I look to the left and I identify previous areas of liquidity. Now looking at this section of the chart right now, we can quite clearly see that in order to push up after we closed above this level right here, we had to have a tap down into the 76 level. Same thing over here, same thing over here. And if you look to the left on the chart, I guarantee the same thing happens. Now, once we understand that, how can we use that to get into a position? Well, quite clearly, we need to wait for a breakout above the range right here, which has just happened. But then following that, we need to wait for a liquidity grab. So as you can see right now, we had a strong breakout above the level, but we weren't able to continue this push upwards because we hadn't grabbed liquidity yet. So all I would need to do in order to get into a position is first of all see a tap down into this 76 level. Now combining this with my other confluences, I'm able to get completely accurate entries and not have to worry about price reversing because I know my liquidity has been tapped. But this goes deeper than actually just entry models and specific criteria. Once you have a set guideline of exactly what you need to enter off of, your psychology is going to be rock solid. Now, why is that? Well, when you enter through FOMO or when you enter through something essentially emotional, you are not priming your psychology. You have no rationale behind the entry, and that means that when you get into the trade, you have no rationale to manage the trade off of. Whereas if I have an understanding that price needs to come down and tap into this level before making a continuation up, once this level is respected and we move past it, I now have a logical reasoning behind the trade as well as the breakout that's occurred. And I also have a mitigation area to understand where this trade is going to go wrong. So if this trade does end up coming back down below the level right here and closing below the liquidity area, I most likely know there is no reason for that trade to do so. And if it does that, the trade is most likely invalid and I can exit. If you don't have something like this when you're entering, you are going to be absolutely cooked. And another way that we can find liquidity, as well as looking at previous price action data, is by looking at session highs and lows. Now, how do we do this? Well, very, very simply, I go over to indicators and I type in market sessions. Now, you can use any of these. They're pretty much all the same. I use this one by Leviathan, and you can quite clearly see sweeping session highs and lows results in liquidity generation. And why is that? Because orders are being left above and below these session highs. Now, we can see quite clearly in the past, you make extended moves above these highs and below these lows before a continuation upwards. You can quite clearly see here, we made a strong push below Asia lows before a massive extended push towards the upside. Now, why is that? That is purely the market generating orders. And how do we utilize that to our benefit? Well, the difference between a continuation and a liquidity sweep is exactly this, the reaction. So how do we capitalize on that? Well, if you're waiting for liquidity off of a session high or low, the easiest way to do that is draw up your range, which we can see we have right here. And then we're going to need to see how price reacts off the session high and low. Now, if this was to do something like this, come back down below and then slowly trickle back down like this, the likelihood is that is not a liquidity grab. That is purely just a continuation of this downwards trend. However, as you can see right here, we came back down and swept the lows, followed by a strong reaction upwards and a change in market structure. And that brings me on to my third characteristic of an entry right here, which is the shift in market structure. Once you shift that market structure, you are very, very highly likely to continue in the direction. So as you can see here, we were making bearish price action to the downside. And the moment you get that liquidity sweep followed by a market structure shift, you can see the results. A strong and extended push all the way to the upside. Now, realistically, combining these three things are going to be an absolute monster for your trading. But let me show you the entry model that absolutely changed everything for me. It's counterintuitive, but the results speak for themselves. So if we take a look here, take this indicator off, and we go ahead and actually look at this range right here. A lot of people are going to be telling you not to trade within the range, and they're probably right to say that. But I have developed an entry model that enables you to do exactly that. And you can see quite clearly here how this is going to work. Now, I'm sure a lot of you are familiar with accumulation, manipulation, distribution, and that is just fancy ICT terms for a liquidity grab after ranging. And you can see quite clearly here, we have a strong push up followed by a range, otherwise known as accumulation, then a liquidity grab below the levels, and then an expanded push up. Now, this entry model right here relies exactly on that. As you can see, we are in this range right now. We are strongly within the range. You might even say the range is between these 2 points right here. And what we're going to be looking for within this range, first of all, understanding higher time frame bias. Now, I have a video on this on my channel, so if you haven't seen it already, go and watch it. But this is the entry model that changed everything for me. When you are ranging within a specific area and consolidating, as long as you are going with the trend, so currently we are in a bullish trend, you can look for a sweep below the level, which we have right here. Bonus points if it sweeps below a previous low, which this candle did right here as well. And then all you need to do is wait for a bullish candle close after that liquidity sweep right there, which as you can see, we do right here, followed by an immediate entry on the buys. Now, why an immediate entry? Because we are not needing liquidity, because this is the sweep that we are using for the liquidity. Now, you could also enter on this candle, but waiting for the sweep allows you to actually go ahead and get a higher win rate. Now, watch what happens when I apply this to a recent trade. The difference between an amateur and a professional entry is absolutely shocking. As you can see, a lot of people using my Skydweller model would be waiting for liquidity. And that is okay, that's completely valid. But when we combine the understanding of current liquidity within this model, we can go ahead and take positions without the need for extra liquidity. So you can see quite clearly here, we were consolidating for a while within this range. Then we have a strong sweep below the level, coming down and tapping nearly into the bottom of the next range. Now, all you need to see after that is whether or not we've swept a low, which we have done here. This is actually a session low, followed by an actual immediate reversal and a strong bullish close. Now, if we are understanding that this wick right here is the liquidity, why would we need more liquidity to be generated on the next candle? We would not. So this is where my aggressive entry model off the rip comes into play. All you have to do is go ahead and take an immediate buy off the rip, stops below the liquidity area, TP up towards the top of the next range, and that is your entry model. So simple, but yet so effective. And the difference between me and your favorite guru is I'm not looking for 15 different confluences before I enter a trade. I'm not over-analyzing using SMTs, breaker blocks, FVGs, IFVGs, all of that. I'm looking for 3 or 4 simple confluences that are all aligning using multi-time frame analysis and then entering the trade. Right here on this position, every single confluence was aligned. My higher time frame bias was bullish. We had the liquidity sweep after the bullish close. We also had a session low sweep. We had a bottom wick followed by the volume pushing up with an extensive move. This is simple trading combined with high level concepts. But this next concept separates profitable traders from everyone else, and it's not about where you enter, but it's about how you manage the position. Now, the other day I was in a position from down here, and as you can see, we quite clearly ran up into profit. But what you might not see right here is we actually went into profit quite highly, came into drawdown, and then survived the entire trade. Now, a normal trader might go ahead and put their stops to break even, and might even go ahead and close when they see that initial profit. But I understood the liquidity generation that I've just been teaching you, and I was able to stack a second position on the flip of this candle. Because as you can see from everything that I've taught you, once this next candle, even though we're in profit, comes back down and breaks not one low, but 2 previous candle lows, and then flips after closing above the range, this is a massive confluence for me. Previous candle lows being broken, followed by the rejection and flip of the candle, is when you really build momentum. Flipping on the candle after a bottom wick is an indication that you've rejected the bearish momentum, collected all those orders from down below, and you are essentially ready to push. So what did I do? After entering the first position right here, I was able to stack a second position in profit, riding them both up towards the top of the range here. And what that enabled me to do is effectively double my profit with minimal addition to my risk, understanding liquidity concepts. But here's something crazy. My best entries feel completely boring. And if you're excited about an entry, you've probably done it wrong. By the way, I break down these entries live every single day in my free Discord, so the link is down below if you want to watch. But the best entries for me feel completely boring because I understand there is such a high probability of me winning on them. And the reason for that is because I am only entering trades when I am 100% certain of the direction. And if the trade was to go against my direction, I would be completely shocked. Now, what this means is there should be absolutely zero likelihood in your head that when you enter a trade, it goes against you. If you are thinking before you enter a position, oh, this could go against me, it could go bearish, but it also could go in my direction and continue bullish, you are trading incorrectly. You should be completely dumbfounded if the trade goes against you, because once you understand you are taking A+ setups only where you have no other outcome except a win, and if the win doesn't play out, something has gone wrong within the market, you take away all personal accountability from yourselves. But let me show you an example of what that looked like last week. Now, the other day on stream, I had a clean entry, a very, very nice entry that I was able to catch. However, what immediately happened after it was we ended up hovering about. We ended up hovering about. The trade was just here, live on stream. And what happened was we made a move up after the breakout, but then as you can see, we started to hover about and close doji. And what happened next was we made an extended move to the downside and would have hit my stops. But like I said, using the concept I just taught you 10 seconds ago and understanding if there is a likelihood that the trade could go against you, or if there's even an inkling within your mind that the trade could go against you, you need to either not take the trade or get out of it. Because this entry turned against me and I immediately knew my edge had gone away from the charts. And that is my sign to get out of the market. But there's a dark side to entry models that nobody talks about, and even perfect entries can destroy your account if you ignore this one thing. Let's imagine right here we have 20 coins, okay? And you have a 50% chance of guessing the correct side of the coin. And if you do guess the correct side of the coin, you get a 110% gain. Now, any trader will tell you this is a profitable system. But here's the dark side of it. Let's imagine you are now risking 10 coins per flip. Well, even with a 50% chance of you guessing it right, probability states that within 3 spins of the coin, you are going to get 2 that land the same way. So you are going to get 2 wrong in a row. And what you can see quite clearly there, if you're risking 10 in one go, is you are going to quickly be left with 0 coins. Now, even though this right here was a profitable system, the fact that your risk was so high means that even when your probability is playing out, you are stopping yourself from letting the longer term probability play out because you are risking too highly and you've blown your bankroll. This is why adequate position sizing is so important, because even if you have the correct edge and the correct entry model, you can cook yourself just by over risking. Now, this is where most traders get confused because they think the entry is about prediction when it's actually about probability. Now, the real purpose of an entry model is not to be correct in the market because, again, we are not always going to be correct. The real purpose of an entry model is to go ahead and actually exercise probability with a profitable setup and a profitable system. And what does that mean? Well, you are not trying to predict being right. You are just understanding. You have back tested or forward tested your data, and you know that with each specific entry model, there is a certain chance that the setup plays out. And with each setup, there's a certain reward that you get for each trade. And what that means is you are exercising a profitable system by following the plan. It does not matter if you are right on any individual trade. It just matters whether that system has the ability and the time and the exercise to play out. But now I'm going to show you something really controversial, because sometimes the worst looking entry is actually the best. And what I mean by this is a lot of people are so focused on risk to reward that they are going to go ahead and tell you you need to have the tightest stop loss and you need to have the biggest take profit that you possibly can. When in reality, that is not what the market follows. The market does not care about your risk to reward. It does not care about your order size. It only cares about the rest of the market and the orders coming in and out. So with that being said, if I know for a fact that the most logical stop loss is below these lows right here, and I know for a fact that every single time in the past price has rejected off of this level right here, why the hell would I go and set my TP way higher and my stop loss way tighter just to get a better risk to reward? This is not what the market cares about. The market cares about liquidity areas, rejection levels, and price action. So following that, we are going to set our take profits at the key levels right here, which is the top of the range, and our stop loss is going to be below liquidity areas, below structure, or below key levels. And this is why psychological barriers are preventing most traders from taking the best entries, because they see a guru telling them they need a 2-to-1 or a 3-to-1, and that is cooking them realistically. But listen, even with the perfect entry model, there's one thing that will sabotage everything, and that is your greed. You need to be managing the trade based off of not your emotions, but what price action is telling you. Fear and greed will kill a trader completely. So what does that mean? It means we need to be managing our positions based off of structure, off of liquidity, off of price action. If we're in buys like this and the market is printing bullish structure, which it is here, then great, we can continue in the buys. But if this was to come back down and start to create bearish structure back within the range, we need to get out of the position. And you can see quite clearly there, I'm not saying if I go $1,000 up, I need to manage, or if I go $500 down, I need to close. I'm talking about price levels only. So make sure when you're entering a position, you need to understand the reason you manage the trade has to be based off the market. Now look, if you want to implement this tomorrow, here's your exact roadmap. You need to go ahead and find a criteria within your setup that is essentially your A+ model. Now, once you have that, go to the TRLS YouTube channel, if you haven't already, to find your A+ model if you don't already have one. Once you have that, you need to understand the adequate risk for your setup. You also need to understand the market conditions that need to be present for you to enter a trade, and that is going to be DLV, like we discussed in the beginning. And finally, you need to forward test your setups to go and collect data so that you can know how to exercise your positions in future. But look, there's the complete breakdown of every single entry model that transformed my trading. Now, it's not sexy, it's not exciting, but it is consistently profitable. And here's the thing, understanding entry models is conceptually just the start. Seeing them applied in real time across different markets is where real mastery happens. And that's exactly why I run live entry analysis in our free Discord community. Every single day, I'm breaking down my entries in real time, explaining exactly why I'm entering, where I am, and how I'm managing risk. We've got over 6,000 active traders in there, all working on perfecting their entries together. No signals, no hand-holding, just pure education and traders helping traders improve. Now, if you want to see these entry models in action and ask questions as trades develop, click the link below. Tomorrow morning, whilst others are guessing their entries, you'll be executing with precision. Join us in the Discord. Your entries will never be the same.